Welcome to those who joined us. Thanks very much. It looks like we are about to go ahead. I'm Sharon Constanson. I am CEO of Valuefin and of Constanson Currencies, two global foreign exchange risk management companies. And today we're going to be covering a topic that is quite complex. We're going to be literally just skimming over the top of it for the next half an hour. What we're going to be covering today is a very complex part of foreign exchange risk management, which is, and the question is, does foreign exchange accounting lie? The reason that we ask the question in such a specific way is because the two don't correlate and give you the same answers. So what we're going to cover today is why there are various differences, what sort of actions you can take, how does it impact your decision making, how does it reflect in the accounts. So all these are things that we're going to just very, very briefly touch on during today's session. And we want to ask the question is why? Why do they end up looking so different between our business P&L expectations and our accounting P&L expectations, or realities, put it that way? What I'm going to evidence through you is through a graphic image, and then again through some number crunching, that actually at the end of a perfect example, the answers are the same. But in real life, that never actually really materializes in that way. So the problem that you've got is everything's in one pot. Accounting systems are constantly revaluing things. You end up with the year end occurring in the life cycle of something that is happening. What goes through the bank account happens in stages, not all at the same time. Exposures that occur and risks that arise don't materialize into the accounting system at the same time they do rise as a business risk. Forward contracts that you take don't come into the accounting system in the same way unless you're hedge accounting, and your sales rates and accounting rates are different. Those are just a few reasons why we have this degree of problem. So very, very challenging for all of us who are in the accounting world and end up with this gray space from a foreign exchange reality point of view. I'm going to now just run through a graphic to try and identify so that people can respect when they think of their own accounting environments, how different these things are. So the first thing that happens is we have a sales rate in the system. We're incentivizing our sales team. We're having a look at the competitor market, and we're looking for customers. And we're working on a sterling dollar rate of £1.30. So let's assume that is the sales rate at this point in time. Salespeople find a customer, they sell some goods to the customer, the orders are placed, and at that point in time, the market spot rate is 133. So we've seen a movement during that period. Let's assume that the company policy is to be 100% covered. They take out the cover, and at that point in time, they get a market rate of 134. We now have three rates already. At this point, from a business perspective, the business is fully hedged. There's no P&L other than that minor difference between the sales rate and the forward cover rate of 0.01, and the business profit is secured between the sales rate and the forward cover rate. So we've secured a profit of 0.03, and that is as far as the business sales people, that is the end of the equation. This is where the trouble starts, and we end up with a far more complex environment that we're having to deal with. And the thing is, this pot that I spoke to you about a few moments ago, everything ends up in this pot. So at a point in time, the shipment is sent out, goods have now left, an invoice gets raised, creditor gets raised, and at that point in time, the accounting rate in the system is now 128. So at 128, the system raises the invoice. A month later, customer still hasn't paid. We've given them 90 days terms, for example, and we still have this money that is due to us at that point in time. And at that month end, the rate now is 135. So we now have a fifth rate in the system. And as a result of that, a P&L entry will go through the books. Difference between 128 and 135. You'll notice those two rates have got nothing to do with the fact that we are fully hedged at 134. So very different rates. A year end occurs, and let's assume at this year end the rate has moved to 140. And at 140, we now have another P&L entry between 140 and 135 that goes through the system. At the same time, if our accountants are wide awake enough, they'll have a look at our forward cover spreadsheet that's nowhere in our accounting system, and we'll do a revaluation mark to market to determine if that portfolio were cancelled, what would the P&L number of that be? Month later, we still haven't got the money in from the customer, and it's now at 138. We have another P&L revaluation entry that has gone through. Now, some of these, the grey ones are unrealized, purple ones are realized. So we end up with a mix of some going through the balance sheet, some going through the income statement, some going through the unrealized account, some through the realized account. And at the point we talked about a moment ago was where the revaluation occurred at year end. Now we get to the final stage of the equation, and the customer sends the money, sends the dollars to us, and we convert those dollars into sterling. We utilize the cover, but because the invoice actually went out for a higher value than we originally had the order, they added another couple of pallets onto the shipment. We utilized some spot to make up the difference, and we made the payment, and the funds went through the bank account. The other complication we've got is we've got many of these happening all the time, constantly moving forward through the books at the same point in time. Now, what I've done, and for people who now want to understand from a business perspective, hopefully this has given you an idea of where the cloud of grey non-transparency of foreign exchange is arising, because you're ending up with all these various numbers occurring. So if we simply look at it, at just this one single transaction, we're sitting in this position where you've got your sales order that we talked about. We've worked on 100,000 US dollars. And what we've marked up here, what is in the spreadsheet, what's in reality in the accounting system, and what are all these steps that are occurring. So we've taken out the cover, we've got the sales order, we've taken out the cover, we've extended the cover, 3,000 has gone through the bank account, we've extended the contract again, and another further 1,500 has gone via the bank account. We've got our new forward contract, and I've calculated here where it's worth. I'm not going to try and go through these numbers in detail. This is too short a session for it, but just as a very high level, we end up with a net business position based on 3,000 positive, 1,500 negative, 72,000 maturity, and an additional spot contract cost a company revenue to the company of 87,943. That is what happened business-wise. So that is what occurred on the forward exchange contract side and what went through the bank account. Now we have a very different picture as to what goes through the accounting system and during that same period. So we have the cover that was taken out. We have it revalued now at that monthly basis. So those pictures of the down arrows that we looked at earlier, we go through the revaluation. The first P&L number was an unrealized minus 4,000. Second one was the purple one I showed you, was a realized 3,000 outflow. And then we had another unrealized one in the last month before payment of 1,200. So these are noises going through the balance sheet, going through the income statement. We then have the receipt of the funds going through the two contracts we looked at on the other page. And we've ended up coming back after our two swap contracts and the movements of the 87,000. So that is what went through the forward contracts. But looking down at the bottom, what actually went through the accounting system? The accounting system were not those numbers we've seen above. There was a 93, a minus 4, a minus 3, a 1, and a 900. That together does come back to the same number. So we have a double check here to prove that your accounting systems do come back to what they should. But you can see at no point during the journey of the life of this order have we got accurate risk management information in the accounting system. And the accounting system is not telling us what the business P&L is at any point in time. And at the end, the only way you've got the P&L is understanding what your comparison is from your sales rate to your actual revenue rate, which will generate the P&L at a business level, but that does not come through the accounting system. So your accounting system is giving you something very different. The other exercise that you have that adds to the accounting noise is that the forward contracts get revalued. So in the case of the forward contract being revalued at the year-end point, there would be a realized P&L of 3,198, in addition to the revaluation exercises you're doing on the debtors. So your debtors and your contracts are now, both of them, brought in at year-end, not on a monthly basis. So I think what we can see from this is how easy it is to become confused as to whether you're making profit, not making a profit, and what's showing in the accounting system. So when a customer comes to me and says, I'm making a foreign exchange loss, my first reaction is you are recording an unrealized or realized position at a moment in time. It may or may not be a loss. The important part is to try and get under that grayness, under that cloud, and to understand what is truly the P&L position. So the things that the company can do is they're obviously looking at their policy. Is their policy aligned to their sales strategy, to their costing policy? So am I treating a short-term currency requirement with a short-term strategy? Am I addressing a long-term requirement with a long-term strategy? Am I saying that I have an ability to change my customer price, therefore I've got more flexibility? Or am I saying I'm locked into an annual rate for the year to all my customers and have very little flexibility? Is my customer trying to push me out of the market by underpricing me? All these things have to now align to your foreign exchange strategy, and knowing that your accounting strategy, your accounting system is going to show some different numbers. So it is quite important for companies to try and determine whether they're actually making a GP profit on their foreign exchange elements of the business, which is either any of their imported product that is going into what they're making, or any of the manufactured, finished, completed outgoing products that are going out to an international customer. So we've talked about some of these things as well, but one of the other ones that is quite key, and one that discussed very often with clients, is around the sales incentive side as well. If you're looking at the sales side, is you've got to incentivize your people to sell the product. They've got to want to make money out of it. That's what salespeople are about, and they've got to sell it at the right price. That has, again, got nothing to do with your foreign exchange strategy from a hedging point of view, and it's got nothing to do with your accounting strategy. This is another element of foreign exchange that has a different lens on it within the business, and your costing strategy that goes with that. Risk management is another lens on which we have to look at it. If you go back to that visual you had of the pot, we had placed the order and we had taken cover right at the beginning of the cycle in the simplicity of that example. Now, in most cases, that simplicity doesn't exist. You've taken some cover quite soon, some later, some right at the end. So you'll end up with a different approach in how are you managing that foreign exchange element against the risk of what's coming through the accounting, and to, most importantly, actual business P&L. The important thing also to understand is that foreign exchange from a business point of view, it's not a product line, it's not a business line, it's not a profit center. All the foreign exchange aspects should be built back into the business, back into the product, back into making sure you're the most competitive organization. So you don't want sitting there that the sales price is being victimized by a surplus sitting in the accounting system. And what we often do see is where the accounting system, the accounting process of determining the costing rate has got a 2%, 5% Forex variation margin added to it, which means you're penalizing the sales side by 5% and putting 5% P&L into the accounts department. These are the sort of things that you need to be careful about, because that is not business conducive at all. The other aspect that is really important is to achieve any of this understanding of Forex accounting and which lens you are using and what you are trying to understand is the management information you have, and what is the quality of that management information, and how do you try and see through that noise to the genuine P&L figures. So we talked a moment ago about realized and unrealized. You've also got entries that go through the balance sheet and don't go through the income statement, and ultimately might be journalized to the income statement at a later point in time in this journey between placing the order and making the receipt of funds converted from the customer that you have. So what you've got going through the bank are the actual receipts from the customer, and from, as a result of the forward contract and forward contract activity, you've got cash flows, and ultimately the forward contract itself. In the accounting system, you have got the debtors, you've got the revaluation exercises that occur on a monthly basis, and you're creating this constant churn of change of what that debtor is worth. Now, for example, one way in which that can be addressed is that you have a season or an annual accounting rate, and you don't have something that changes every month. Now, there's reasons for both being used and both having their advantages, and one of them will link to the cover policy and the current cover position at that moment in time as to which of those you may, from an alignment point of view, choose to use. So at the end of the outcome, if you had one piece of business only, is the answer at the end will be the same. If whether that is 1 day, 9 months, whatever the duration is between the beginning and the end, it will be the same. But at any point in time, the finance director and the sales director and the business treasury decision makers, whoever they might be doing, are seeing only different stages and chunks of information and not seeing the whole picture which comes across at the end. And the problem that you've got is the business is constantly in a stage in some of the stuff, and some of it therefore is never complete. The timing differences on cash flows can easily be misunderstood and quite often are taken to the income statement in error. The money has gone through the bank account. You've got a new forward contract. The new forward contract's at a different rate because of this cash flow. And the two together are actually what you are going to be receiving. So this is an advance payment that you've had, or an outflow against a future inflow. So these need to go to the balance sheet. It's very important. Otherwise, you end up distorting the information even further than the accounting system is capable of doing on its own in the first place. So where does this money disappear to? It's all in this pot that we've been talking about. The other areas that we get that add to our complications that we've not talked about yet are specifically using foreign currency accounts and holding balances on those accounts, paying out dollars out of a dollar account, paying out euros out of a euro account. And because of the way the accounting system works that we have had a very, very high level look at, and its revaluation processes, the risks to the revaluations of the balances and movements intra-month on those accounts is extremely high. Another area where we can get a very high distortion of what the truth actually is. The problem that you've got as you've looked at it, at any point in those months in between, potentially over a 6-month period, at no point in the accounting system did you have the right information as to what is the current position. So therefore, you need to have information that is pulled together outside of the accounting system to understand what the true P&L position is of your foreign exchange, knowing that at any point in time, there are many journeys that are being collated in that information. There is something that I'm sure many of you either know about or have heard about or have been warned about, is hedge accounting. Hedge accounting has one huge benefit. It brings in the order and it brings in the forward cover if they have occurred. If they have occurred, they come in at that point in time into the system and they are married to each other. And you therefore have, in simplistic terms, the business P&L is actually locked in right at the beginning through the hedge accounting mechanism. So the hedge accounting mechanism has a huge benefit from that perspective. It is complex, it's difficult. Auditors don't tend to like it, accountants don't tend to like it. But actually, if you're in a big business where this is a big impact on the P&L, you have to go through the process of hedge accounting, which then at least smooths the results to correlate the actual business reality. So an important one to consider, not to just be ignored because it is complex. So at this point, I'm going to open up to any questions that you might have. And some of the things that we can talk about, for example, are the importance of having the right information. So if you've got the right information, how do you use it? And how does that give you some of the answers? The most critical thing is when you're doing your foreign exchange is to do the right business decision first. The accounting is going to be confusing whatever you do. You have to be making the right business decision of hedging at the right time for the company. Once you've made that decision, then you have a whole bunch of tactical foreign exchange decisions that you need to make. And the other important aspect is to align the policy to the activity of the business. So if you are buying on a needs basis, just in time, I buy it, I pay for it spot, I sell it to the customer at the rate I paid. That is very, very simple. You don't end up with a lot of foreign exchange activities. Or you have an annual accounting rate, you've got your forward contract rates, you've got the rate at which you've worked out the sales to the customer, and you've now got a business P&L based on the way you have hedged it. So those are your sort of two ends of the continuum. In between, you have what is the practical aspects of a morphing underlying business that's constantly changing, and a bucket of cover that you're looking for to interrogate and utilize to protect the business from a hedging and a risk management point of view. I have very quickly, and sorry for the late start, covered all the different high-level concerns one might have about foreign exchange and why it does trouble a lot of people who are very highly trained in the area of financial accounting. And it can be very, very complex. So I would love to hear from you via the Q&A, and I see we have got one already. Please, others, it would be lovely if you could just give us some insights. Very, very valid question. We've gone way up high level, right up into the boardroom, and we've said, how can directors be convinced that when they sign off the balance sheet, that they understand the Forex element item of unrealized or realized or being held in timing differences that is sitting in the balance sheet? To add to that, how can they be assured that the realized and unrealized entries that are going through the income statement have any correlation to reality? Now, hopefully the accountants or auditors who have done the books will give some degree of assurance around that. My concern always in this area is the degree of knowledge that is present at a auditor level for this. They have process, totally understand what they need to do from a process point of view, but the so what does that mean to the business? So what does this answer look right? That is where you get some very, very different outcomes. To answer your question, Craig, on the information that most accounting systems will make available to the auditors and to the accounting staff is quite limited. So you tend to work immediately outside in spreadsheets, or if you're looking at something where you're looking at the services we have, where we've got an accounting and reporting system based on the data that's in the system, you are looking outside the accounting system for evidence and to prove what the numbers are that are coming through. And that would be looking at those many journeys of debtors and creditors through the system, forward contracts on orders, and funds on account being your primary areas that are going to throw up some unusual numbers, and needing to understand them when they're collated is, are they viable for that moment? The problem you'll get is if you've got, for example, you have taken cover on a £500 sale in dollars, and that is excessive for your business at this point in the business's time. It is quite a large transaction against the averages. And because it is an order and you wanted to hedge it because of the risk to the business, and you've now priced to the customer based on your forward cover, that whole lot is all aligned and it's all now packaged up, and there's no P&L risk in it at this moment in time. What you've got though is you've now got a year end before that occurs that will revalue certain aspects of this totally packaged up deal and throw out an unrealized or realized figure that is completely wrong. By the time you get to the payment, you'll get another wrong the other way, the net right coming through ultimately at the end. But your biggest risk to businesses is where they have hedged orders, and those are being brought into the accounting system at year end and not being done via a hedge accounting mechanism. Any other questions? Anybody want to drop anything into the Q&A for us? Thank you, Jeremy. Have hedge accounting rules changed to ensure off-balance sheet exposures that are hedged do not cause a business to go bankrupt? Um, the problem, if you've got an off-balance sheet exposure and an off-balance sheet forward contract and the two are married by hedge accounting, Jeremy, you shouldn't have a problem. What you might have is you have got the forward contract and the accountants are not allowing you, even through the hedge accounting process, to actually reflect the order, the sales order or the purchase order, whichever it might be, for which you have hedged, to come into the equation at the same time. So I don't know the specific instance, but technically it shouldn't create the problem. But in reality, I know of many occasions because there's a package of things. Okay, I'm looking at a specific example of South African Airways. I've not looked at the numbers specifically, and when I look at the words, I will always distrust whether that is telling us the exact foreign exchange or exact business activities that are occurring. But hedge accounting, if anything, stabilizes the situation rather than destabilizes the situation. So I know in the case of SA Airways, I know when they first took over an aspect of their Forex management, because I used to do quite a lot of SA Airways, the first thing they did was cancel the entire forward portfolio and take the business into a totally unhedged position. I know they have also got the complexity in airlines where you're sitting with a commodity as well, being oil, dollar-based commodity, and you're looking to hedge that risk at the same time. And you've got long-dated fleets on aircraft that have got staged payment programs as well and different ownership structures as they transfer ownership onto the balance sheet. So you've got a large number of competing factors that words can easily obscure to the man in the street as to what elements might have pushed that in. And I haven't studied it well enough, Jeremy. I wish I had, because then I'd love to give you the answer right now. But there'll be a many component factors that put that together. This is a whirlwind tour. What we are doing is breaking this down into bite-sized pieces to actually run proper courses on them. We've been writing white papers on this kind of information and getting to the different bits. The part that I felt was important is to do something very high level to basically understand at a director and board level, at a finance director level, it's okay to feel stupid you don't understand what's going on. It's okay to feel like you've got a big grey cloud and you can't see the detail. That is a fact. That is actually what the problem is. And it's making sure you find the methodology of trying to see through that and to understand what the true numbers are. And that's where something like the accounting, the systems that ValueFin and Constance and Currencies operate for our customers do give you that degree of insight and help solve these issues. So thank you very much to everybody. I really appreciate the time and effort that you have taken to be with us today, and look forward to people reaching out for some support if they would like it. Thanks to everybody.